Hi everyone, Natu here again, back with another video. And in this video, I'm here to explain and try to see if we can answer, is it harder to raise $1 million or $10 million? And so yeah, because what's really interesting is that there's so many different ways of raising capital and there's so many people that have different experiences. So it's really hard for somebody from one perspective and one side of somebody who has one type of experience and one perspective to answer a question when it's so broad like that. And so, first, as we discussed in previous videos, really the main thing is just to understand what type of transaction it is to learn more about it. In terms of is it easier? Ease, it depends on, because whenever there's a transaction, there's the company, there's a transaction itself, like whether it's debt or equity and what is the need there, and obviously the people involved in the company. And so, it depends on, it's completely dependent on the company what stage is the company at. And so that's why it's really impossible to answer the question just flat out, is it harder to raise 1 million or 10 million? But okay, so let's say assuming, that the company is, a revenue generating company is making tens of millions of dollars every year, then of course it may be easier to raise 1 million because, if they're making tens of millions of dollars a year, it's just like them getting another customer. So, just entertain us on this thought experiment. But then, if there's a company that hasn't made 1 cent and they want to raise 10 million, versus a company that hasn't made 1 cent, they want to raise 1 million, it's really difficult, and it may be on more of the side of the smaller transaction. And this is assuming this is an equity transaction, where people are buying shares in the target company. And so that's the second point. It's like, is this a debt transaction or an equity transaction? And or is it a combination of both? Is it a convertible notes? Is it a public markets transaction? Like, there's just so many different types of transaction. It's crazy, and it's literally impossible to get such a blanket statement answered. But we're going to assume that this is in the private capital markets, meaning that it's not publicly traded security, because experience shows us that raising capital for companies that are publicly traded is much easier than raising capital for companies that are privately traded. It's just look at, go to anyone can, anyone's grandmother can go to NASDAQ and go to all these people and invest. But then to get a deal that's off market, that's a different story completely. So let's assume that the companies are off market and these are private market companies, that aren't on any public exchange. And let's assume that this is an equity transaction. And let's assume that the company is revenue generating. It made 10 million last year, and its profit margin, let's just say it had a 30% profit margin. It may be easier to, so depending on the dynamics, if it's a company like that, it both could be really easy. But if you want to take it towards, if you want to sell it to placement agents, or if you want to work with placement agents or consultants and people that want to, if you want to spread it out a bit more and have as many options as possible, then in my opinion, the larger transactions give you more options, and it takes away some control that you have in how the deal goes. And it's more of a quote-unquote syndication. And when I say syndication, a lot of people in real estate would say that, oh, it's like a syndication in real estate. This is like investment bank syndication. Basically, investment banks that send a deal to other people who run investment banks, who send a deal to other people who run investment banks. So it's like a broker-to-broker dealer collaboration. And this is a type of process that when you see deals that are minimum 10 million and go up to 25 million and even 100 million, and these crazy deals that are really large, typically, many placement agents take a piece of that. And the reason why is obviously because of the percentage cut that they would get on closing. And because of that, they have a lot of private relationships to people that can handle, like private relationships to private equity firms and family offices who are able to hit the larger check sizes. But people who are looking to raise larger amounts of capital, generally, it may be harder. It's hard to get those relationships of a firm that can wire like that kind of money. And so these relationships are very guarded, and a lot of either consultants, investment banks, family offices, private equity firms, or people that call themselves any of those four words would have these relationships with these people, and just because of all the commission fees on these deals. And so they basically, the funder, imagine a funder is like somebody like this. All the people that can benefit from the funder just wrap them up, and because of all the commissions, and so they just wrap them up kind of like flies on dung. And what happens in the end is that it's hard for people to actually know who are the real funders or who aren't the real ones, because everyone calls themselves an investor, especially the ones that go towards where the real meat and the real gold is. So as a result, if you want to, generally it can be easier to work with, people who are investment banks or run investment banks or family offices if you want to take the deal in that direction, but you may lose more control over the deal if it's a larger transaction, because those relationships are really well guarded, even in the age of the information age. However, if you want to do a smaller transaction, you may have more control over it, but it may take some more autonomy from you to be able to get the people to the table. And it may, and this is just, and I'm just speaking, broadly speaking, there are always exceptions to all these rules, but if you do a $1 million raise and you're a revenue generating company, presumably it's, a lot of people have success with getting many small check sizes, and doing like even a crowdfunding round or getting many small check sizes to the table, because people aren't incentivized to make as much money on the on a small raise. So you're going to see less placement agents, less quote-unquote family offices, private equity firms, and whatever consultants that try to help you get that deal done, because the amount that they can make, the percentage that they can make on the 1 million is way lower, meaning that you may get more direct access to investors who would potentially, pay 50K or whatever, and until you grow to that 1 million. And as a result, it can be easier to have more control over who are the investors in a smaller tranche. Because, think about it this way. If you're doing a pay-per-click campaign or a campaign to actually try to get investors to the table for your deal, you can measure the ROI on it if you pay for Facebook ads, right? But if because like you can say, oh, this investor invested 20K, 4K, even 100K and whatever, and you can bring them through via pay-per-click ads on the internet. But then if you want to get somebody to wire like 5 million and whatever, it's impossible. It's based on, let me know if you found somebody or found anyone who did it. But it's really hard to find people that have done it. We actually have, but it's not something that you can get the ROI on, like you can map it out like that. And these are all relationships with human beings. They don't really go through a tight sales process or anything like that. So my point is that, if you're really good at being self-managing and self-controlling in all the types of people if you're to have a process nailed down like crazy, where you're able to go on a platform like Republic or whatever, or have your own proprietary platform, do a Reg CF or something like that, and have all the incentive mechanisms so that you say, oh, we're only have this much, create fake scarcity, say, oh, we're only available for this much time. You should read the book Unsubscribed or Oversubscribed by Daniel Priestley. It goes over all this, where you create all these scarcity signals so that you can bring people in. You can get people to pay like 50K or 100 or 5K. Many people pay 5K. If you want to do that strategy, that's one way to raise 1 million, and just get a bunch of people paying that much, and have a campaign with that in mind. Another way is to just gain relationships with people to write that one check and so on. It may be harder if it's like a $1 million raise or smaller. It's harder to use investment banks, placement agents, and broker dealers and family offices. I'm just speaking broadly. I mean the larger institutional investors for deals that are 1 million, because the percentage that people would get is way less. And the crowdfunding platforms and so on, that's a better route, because because they make their commission on that, and then a lot of people lack some of the technical skills in order to get the platform set up. So it may make more sense to have a more self-controlled process to work with investors in that sense. But if you actually want to get a large deal done, like over like 10 million, 25 million and so on, then the process is completely different, because then you're playing with a lot of people in the game, like all these middlemen and so on, because everyone's getting a piece of the pie, and the people are getting millions in commission on a $20 million deal, $10 million deal. And so now you have more guarded people and more complicated fund structures and different ways that more people are more sophisticated who deploy capital, meaning that the investors are not as big newbies. They don't need your education. They've done more deals than you have, most likely, if they're wiring a $20 million check from their firm. So it's a different game in the sense that the game is just about, for the larger transactions, it would just be about getting access to those people, getting the feedback from those people and knowing them and meeting them, rather than educating them, bringing them on and selling them hard. Yes, there's always going to be a sales process, but the sales process is less consumer-like for the larger transactions and more consumer-like for the smaller transactions. And the smaller the transactions get, the more the investors become like customers, and the larger it gets, the more the investors become like a beast, like something else. $1 million raises, more self-controlled, more self-contained. You're treating your investors like customers, essentially, because if they're sending 50K, like 5K, 10K, whatever, I mean, there are tons of businesses that charge for that, and that's not really that much money. If you're working on, larger raises, the game is different, and it requires, just a heavy compliance, but less in terms of investor education because the investors are already sophisticated, more in terms of knowing how to navigate the broker-dealer world and making high-quality relationships to private equity firms and extremely rich firms. And so it requires a different set of skills to be able to talk to the people and the middlemen in that game so that you can pass by the middlemen and get to the capital that you need. You have to have that sort of, you have to have that package together to entice those parties, and it's a completely different sales process. And so depending on your gifts and the types of resources that you have available, you should choose to see, what's going to happen. But broadly speaking, this is just equity. But if you're talking about debt, that can be a completely different story. We're going to save that for another video. So use and change your preferences based on what's going on, and based on whether you treat your investors like customers or you treat your investors like more strategic and big. Then that's the approach I would take when looking at both sides of this. And thank you for watching this video. I hope this brought some insight into $10 million. What's really easier, $10 million raise versus $1 million raise? There's no easy answer, but considering your pros and cons and your strengths and weaknesses of your outlook, use it and amend it to fit it within your own strategy. And that's the part that nobody talks about on a 2-second video or anything. So I'll leave it to you. Head to raises.com to get it started.